Hello traders, this is Dan Gibby, and in this Master Trader Weekly Trade Review, I'm going to show you how we can generally profit when we short options and credit spreads around charts using the compelling Master Trader strategies, and we can profit even when the stock moves against us. Now, some of you might think, oh, well, you sound like a snake oil salesman, so let me just terminate the video right now. But based upon the mathematical formulas of option pricing, it's true, and that's what I'm going to show you in this video. Now, at Master Trader, we're technical-based traders, so whether we're trading stocks or options, everything starts with a compelling pattern. We buy options when we have a directional setup on the underlying, which means multiple time frames are in alignment, and we're expecting a big move, and we just use call and put options instead of trading the underlying for the benefit of leverage and limited risk. What I'm going to show you in this strategy is selling options and credit spreads around those same compelling patterns, where we're going to earn weekly and monthly income primarily from time decay. When people buy options, it costs money for the right to buy or sell the underlying. We are going to take that opposite side of that bet because we're using the chart pattern to say, I don't think the stock's going to go there. And if we're selling a put option, I'll show you, we're bullish on it. And if we sell a call option, we don't think it's going to go higher. So the time decay that occurs to the option buyers is daily income to us through this time decay called theta is the option Greek for it. Chart patterns are our edge. The beautiful thing is you don't have to time entries with precision. We can be a little sloppy. You're saying, yeah, that's just bouncing around on support, not going anywhere. It's a good credit spread candidate. The higher the implied volatility of the underlying that we're selling, the more premium we're going to get for selling those. Once we're in a trade and we have a whole separate credit spread checklist that we give our subscribers, then we're simply in trade management role. I'm going to show you that also. You can do nothing, let it expire worthless. Or if you don't mind being assigned the underlying, you get an improved cost basis. So you're obtaining the merchandise on sale, if you will, at wholesale. You stop out if the chart pattern fails. We have adjustment strategies, hedging strategies, rolling strategies. We teach all this in our option trading seminars. This strategy works in every single environment, which is another beautiful thing. Some people say, oh, the market's a mess, it's not going anywhere, breakout's failing, breakdown's failing, it's whippy, choppy, trendless, and we're like, that's okay. I guarantee you we will find you credit spread candidates every single day. So here's one GME that we did last week. Everything starts with a pattern, so let's look at it. We had a downtrend here. Biggest green bar in months. Deep retracement. This is what we call a Master Trader buy setup. That would have been a fantastic time to short puts. Again, when we sell a put, we are receiving the premium and we have an obligation to deliver the underlying stock at the agreed upon stock price on or before expiration if the put buyer wants us to buy that stock. The put buyer is going to not have us buy the stock if the option is worthless, if he can buy the stock cheaper on the open market, and that's what we're doing. That would have been a great time to sell out of the money puts on GME. This one is a bullish retest pattern on major support. The blue line is the 20 MA, green 50, red 200. So you can see the flat 20 and 50s. We're in a trading range here. Now back up to the top of the range, and we actually sold it where this arrow is. And you might say, well, Dan, I thought you told me don't buy breakouts from the bottom of the range to the top of the range. That's a correct statement unless we get some type of bullish consolidation at resistance with a correction bar. So this one went sideways for 3 bars at resistance. So that's what we call bullish price action. And then we did a 30-minute high here thinking that it would break out. And it was not a good directional trade where I would buy the stock or buy call options. So we said, you know what? On this pattern, let's sell a way out of the money 115 strike where this green dotted line is. Now, where the stock was at the time when we entered this $115 strike was over 20% lower. So think about that, folks. We're taking in, this is a closed trade. This is reflected in our open and close spreadsheet for our subscribers through the weekly options trader. We sold 115 puts for $115 a share. Hypothetically, if you sold 10 of these contracts, $1,150 would be immediately deposited into your brokerage account, and you have the obligation to buy 1,000 shares on or before 7 days to expiration, which is all this was, if the put buyer wants you to. Now, this OTM means out of the money, so the stock was trading way up here at 145, so out of the money, it was $30 lower. And I also put a note here, there's the technical reason for it, and there was a big bid there, a big bid on those option pricings. That's another strategy we teach. Huge open interest at an important number often acts as additional support or resistance because of the hedging nature of the market makers at that strike. So that was an additional plus, which was confirmed by this major support and bullish price action. So the stock went against us. So why do I have a time glass here? Is because of the time decay every single day. And the option table measures it as the Greek word theta. So theta measures day by day how much of this $1.15 a share is going to be decayed, evaporated, which is my daily profit. And so we let the stock retrace because our stop loss was way down here under this major support. So look at this, folks. It could have fallen 20.1% just to the strike. But our break even on this is when you sell an option, it's the 115 less the $1.15 you took in. So if we were assigned stock, our cost basis is $113.85. So as long as it stays above 113.85, you make money on this as the trade at expiration. So it came down here. You can count the number of days, and we're in trade management mode. We closed half at 40 cents on the 30th there. I said, hey, midpoint here is 14, which means you could have traded it, you could have closed it right there. I said bid 2 cents to close the back half and just be done with it, tighten the stop to under 120, which was still over $5 away, $940 profit on a 10 lot, despite it moving way against us. That does not happen in buying or selling stocks or ETFs or any other instrument for that matter. Our weekly options trader, which this was in, only sells options and credit spreads that expire 10 days or less using our approach, as I just showed you, compelling pattern, and we're making money through the time decay, volatility contraction, and as the stock goes in the intended direction, we also get a more rapid unrealized gain. Another example here, this was a little bit of a longer term one, Duolingo. So here's my pattern. I got flat 50, the 20s rising, the buy setup right here. This is what got my attention to start watching it. This was a bearish gap right here into this green bar, and it closed above the prior bar's high. That's bullish price action at the 20 and 50. The next day, bottoming tail, which means it was a bearish retracement into this bar, closed with a bottoming tail and closing breakout. All this information is telling me buyers are lurking below. So where the arrow's pointing here, that's when we put this trade on. This one was actually 3 weeks of days to expiration. But look, folks, see this green line down here, 65 bucks? The stock was trading at, just eyeball it, $96. And so this one was 31.8% away from the time we entered the stock to this short $65 strike price. As long as for 3 weeks, it's a melting ice cube. It's day by day. If this stock doesn't continue to move, then these puts are just expiring. But here's another example. It went against us after we entered the position where the arrow is here. So we sold these $65 puts for $1 a share. Well, if you did a 10 lot, that's $1,000. It's going right into your brokerage account. Here's our technical setup. Continuation breakout at the 2050. I said at this particular day, the midpoint is 40 cents a share. I said, let's bid 10 cents to try to close it. Well, we didn't get our 10 cents. It kept retracing against us, but even though we closed it into weakness here, it's because of the broader markets. We're also not acting so hot. I said, you know what, here on the 28th, let's just take our money, move on to the next credit spread opportunity. So even though this one went against us, and longer term, I still think this $65 for another 2 weeks looks totally fine. We booked $400 and we're off to the next trade. And why do I show you a glass of orange juice and oranges? Because when we sell options and credit spreads, we're trying to squeeze the juice out of it as quick as possible. The juice meaning the profit, the premium. That when you sell options, your maximum gain is a credit received. So we're playing this game here of maximizing those profits with the least amount of risk, which we do with our approach using the charts. And this is one of the sayings we love to make, which is the underlying message of today's lesson. I made money and the stock went against me. Now, I could show you thousands of examples where the stock went in the intended direction and we made even more money faster. So I'm purposely picking 2 trades here that went against us just to show you the power of time decay. The gains from the time decay and volatility contraction were greater than the small loss of the underlying going against us because of the melting ice cube where everything has to converge at expiration. It's a marvelous strategy. So here's our weekly options trader for credit spreads, and at this particular time, I mean, we just had a beautiful run in the market. Here's a subscriber of ours. I mean, this is him. I just quoted it. This is an absurd strategy, sarcastic tone. We have 2 credit spread courses that teach you exactly what I just gave you a little snippet of here. A great little 5-module course here. We have an amazing 12-module mastery course, covers every imaginable scenario to allow you to put these trades on, to find them, to manage them in any market environment. And then I mentioned in the beginning, we buy options also based on the chart, and this is the directional option strategies. But this week only, July 4th special, any course on our website, you go to mastertrader.com/education, is 25% off with coupon code MTS $25. Hope that helps. Any questions, as always, email Greg or me, and look forward to seeing you in the next trade review video.